Hello, and welcome to Chapter 13 and Sections 13.1 and 13.2, which begins the chapter on after-tax analysis. So in the last chapter, we learned about depreciation, which is, according to the IRS, a tax deduction. And so today we're going to learn how to use the deductions of operating expenses and depreciation to get at a taxable income for income tax purposes for a corporation, and then based on the taxable income, we multiply that by the tax rate. So you should read pages 384 through 393 for today's lesson. And of course, you're watching the video either on Blackboard or YouTube directly. The lecture notes are posted also. And one thing that I've added to this last statement down here at the bottom is that, in fact, all of the homework assignment problems are drawn from the end of chapter problems. So I'm encouraging you to work as many end of chapter problems as you can to test your knowledge of the theory and to see if you can apply it and understand what is being asked in each of these questions, because that's the hardest part of the course, is figuring out what is this question asking of you. And so also the final exam, which I posted a little bit of information to your email accounts, is also pretty much drawn from the end of chapter problems, except where I state that this is something that's not covered in the book. As an example, learning curves were not covered, and they were covered, but not to the extent that I covered them in the lesson. So in that case, you may get a problem that's not drawn from the end of the chapter. But generally speaking, they are. They all are on your homework assignments, and most will be on the final exam. So we'll get right into the terminology that's required. Again, this course is more associated with economics and finance, and so there's a whole new vocabulary for you to learn to master the course. The first term the author discusses is gross income, which is basically called your revenue. It is total income. It's basically all of your sales. If you're an organization that makes sales, that's your gross income. Then you have income taxes, is a tax that the company must pay on their operating profits minus the depreciation deduction. So we'll talk about income taxes a little bit more, but basically corporations have to file quarterly tax returns, unlike, for example, individuals like you or I. We have to only file a tax return once a year. But, corporations file them every quarter, 4 times a year. Net operating, now not every business is a corporation, by the way. There are 3 forms of business ownership. One is an individual who owns a business. Another is a partnership, 2 or more people who own a business. And then finally, there's a corporation, which is a separate entity, from the owners, so to speak. Net operating income is gross income minus the operating expenses. NOI equals GI, gross income minus operating expenses, E. This is called the cash flow before taxes, but we can also, we'll define cash flow before taxes. As far as operating income, this is true, but then we also have cash flow before taxes associated with buying the equipment, which we called P earlier, or the original basis, and also there's a salvage value. Those are not operating incomes, but these are the operating incomes that affect cash flow before taxes. Operating expenses are all the expenses required to produce the gross income. So basically, all expenses of the business. And then taxable income is the amount of income that income taxes must be paid on. Okay, so taxable income is defined by equation 13.1, which is net operating income minus depreciation. And remember, net operating income is defined as gross income minus expenses. So taxable income is gross income minus expenses minus depreciation. The reason depreciation is separated out is because it's not a real operating expense. It's an accounting for the decrease in value of the assets of the corporation or the business, whatever kind of business it is. It may not be, like I said, a corporation. There's three forms of business: corporation, individual ownership, and partnership. Now, the tax rate is defined as T, is the rate that must be applied to the tax income to calculate the taxes to be paid. So income taxes due equals the taxable income times the tax rate. That's equation 3.2. And some corporations are incorporated in states or localities that have state or local income taxes as well. And so if you add those in, then you get what the author calls the effective tax rate, that includes not only the federal tax rate, but the state and local income tax, or any other kind of taxes that may be applied to taxable income. Now, the author defines in equation 13.1, he says that the effective tax rate is the state and local tax rate plus 1 minus the state and local tax rate times the federal tax rate. Now, why is this equation? Well, it turns out that state and local taxes are deductible from the federal taxes. So that's why this equation makes sense, to get the effective tax rate. Most of the time when you're solving a problem, that'll just be given to you. Accountants calculate this for the company. So that's equation 13.3 in your book. And then equation 13.3 takes into account the fact that the state and local taxes are deductible from the company's federal tax. So that's what's going on right here. And then finally, the income taxes due then is the taxable income times the effective tax rate. These two equations are essentially the same. This equation, where T is just the tax rate, say, of the federal tax rate, this includes maybe state and TE includes state and local or other taxes. Normally you'll be given the tax rate, and so you just have to apply it to the taxable income. So equations 2 and 4 are essentially the same equation, and the way you get to the effective tax rate if you have state and local income taxes is through equation 13.3. So we'll move on to an example problem, specifically using some of these equations. This problem says helical products make makes machine springs with elastic redundant elements so that a broken spring will continue to function. The company has gross income of $450,000 with expenses of $230,000 and depreciation of $48,000. Approximate the company's total taxes for a tax rate of 38%. That's a pretty stiff tax rate in today's environment. It wasn't a few years ago. In fact, that would be when that problem was written. But in today's taxing environment, we'll see a little bit later in today's lecture, that's a pretty stiff tax rate. So we're given that the tax rate's 38%. Again, this is a bit high. Most corporate income taxes are 21% now. Of course, that's going to change soon. We will use the given tax rate as it was given in the problem, 38%. Okay, recall that net operating income is defined as the gross income minus the operating expenses. So from equation 13.1, we have taxable income. So I'll look at it right here. Net operating income is gross income minus expenses, which is $450,000 minus $230,000, which gives me $220,000 remaining. Then we subtract the depreciation to get taxable income. So taxable income from equation 13.1 is net operating income minus depreciation, but net operating income is gross income minus expenses. So taxable income is gross income minus expenses minus depreciation, which comes out to be $172,000. Then we simply multiply that times the tax rate of 38% to get $65,360 in taxes that would be due. So a pretty simple problem, just applying the equations that we already looked at. The author gives a tax table of federal corporate tax rates, and honestly, I don't know why he does that, because this table applied to federal income taxes prior to 2018. So for 2019, 2020, and until they change the tax law again, the Tax Cuts and Jobs Act passed in late 2017 created a flat federal corporate tax rate of 21%. So no matter how much income is, it's applied. The federal tax rate as of today is 21%. On a test question, I would give you the tax rate most likely, or ask you to calculate it based on known factors. So the federal corporate tax rate is a flat 21% since 2018 to the present. Section 13.1.3, federal income tax rates for individuals. I'm really not going to cover this. I put it in here. This is the table from the book, table 13.2. This is the rate table for 2018. These rates change almost every year, and we're not going to really be concerned with individual income taxes in this course. We're mainly looking at corporate income taxes. You won't have a problem on the final, and there's no problems that I can think of on your homework assignment that involve individual income taxes. The next thing we want to cover is section 13.2, which is before tax and after tax analysis. So the first equation says simply after tax cash flow after taxes equals cash flow before taxes minus the taxes. That's pretty simple. The cash flow before taxes equals the gross income minus expenses. Basically, that is the operating income, net operating income. But in year 0, generally speaking, you have the price of the equipment, and in year S, you have the salvage value. Oh, I'm sorry, year N, you have the salvage value. And I generally, whenever I create a tax table or a table to work a problem, I include those in separate lines. I'll have a separate line at time 0 for the cost of the investment, and a separate line at time N for the salvage value. Again, because these two things are not operating income. They are part of capital recovery. So that's equation 13.6 that gives you cash flow before taxes. Cash flow after taxes is cash flow before taxes minus the taxes. But taxes, recall, were taxable income times the tax rate. That's equation 13.4 or 13.2. And then you get cash flow before taxes. Remember, the net operating income was gross income minus expenses. And then you also get to deduct the depreciation from that to get taxable income. Multiply that times the tax rate, gives you taxes. Okay. So let's look at an example problem. As an example of the application of the above formulas, a company with an income tax rate of 21% invested $100,000 in equipment that is considered 3-year property, 3-year MACRS, Modified Accelerated Cost Recovery System, depreciation purposes. Remember the MACRS table back, I think it was in chapter 12, would give us for different kinds of recovery periods what the depreciation rates were for each of the years. And remember, 3-year property under MACRS is actually depreciated over 4 years. 5-year property is depreciated over 6 years, and it's always N+1 years under MACRS depreciation. The company estimates that the equipment will produce net cash flow before taxes of $30,000 a year for years, for each of 5 years. Okay, for that would be years 1 through 5, and have a salvage value at the end of year 5 of $10,000. So remember, I'm going to include the cost of the equipment and the salvage value and the cash flow before taxes, but they'll be on separate lines. And so for time 0 or year 0, I have minus the $100,000 investment in my cash flow before taxes. And then in years 1 through 5, I have the $30,000 operating income. And then in year 5, I also have then the plus $10,000 salvage value. Now my depreciation comes directly by multiplying the depreciation rate from the table in chapter 12, table 12.1, I think it is. And recall that I will put that I will give you that table as part of the final exam. So the year 1, I get from that table, I multiply 0.3333 times 100,000, and I get 33,330 as a depreciation charge from my net operating income. So my taxable income, turns out, when I subtract this from this, my taxable income is negative. Well, you really can't pay a negative tax, but I do put a negative tax here by multiplying this negative taxable income times 21% to give me minus $699. Well, why do I do that? Well, I'm just assuming that this company, this is just one cash flow of many, many cash flows for this company. And therefore, what this means is that they'll pay $699 less in taxes in this year than they would have if they didn't do this project. So when I subtract a minus $699 of taxes from the $30,000, I actually am minus a minus, so that gives me a plus, which is plus $30,699 after taxes. This is kind of unusual, where my depreciation actually gives me negative taxable income and therefore negative taxes, and therefore after-tax cash flow is greater than the before-tax. But that's only true in years 1 and 2. After that, we have to start paying taxes. Year 2, the factor from the table is 0.4445. So when I multiply that times always multiplying it times the basis, the original p-value, I get a tax deduction of $44,450, which is subtracted from the net operating income of $30,000 to give me minus $14,500 taxable that year in year 2. So then I multiply that times the tax rate to get minus $3,045 as my tax for that, due to that piece of equipment or that project. And then when I subtract a minus from the 30,000, minus a minus is a plus, so I get $33,045 after taxes. Again, greater than the before tax cash flow. But that's the last time that'll happen. The next year, my depreciation rate from the table in chapter 12 is 0.1481. When I multiply that times 100,000, I get a depreciation charge of $14,810, and I subtract that from the net operating income to give me taxable income, this time a plus $15,190, and then multiplying that times my tax rate of 21%, I get $3,190. When I subtract that plus number from 30,000, I get 26,810 after taxes. Now, the after-tax cash flow is indeed more logical. It's less than the before-tax cash flow because I have a tax due. Here I had a tax deduction, so to speak, or negative tax instead of a positive tax. In year 4, which is the last year that 3-year property is depreciated under MACRS, the factor is 0.0741. When I multiply that times 100,000, I get $7,410 of depreciation. That is subtracted from my taxable, my before tax net operating income to get taxable of $22,590. When I multiply that times 21%, I get a tax bill of $4,744. Subtract that from 30,000 to get 25,256 of taxable, after-tax cash flow. Then in year 5, I have net operating income of $31,000, no depreciation, so I'm paying tax on the full $30,000 at 21% tax rate, gives me a tax bill of $6,300. I subtract that from the $30,000 to give me cash flow after taxes in year 5 due to the operating income of $23,700. But I also have a salvage value there, so I kept that separate, but it's still in year 5. These are both year 5 now, and the depreciation doesn't affect that at all. So it's all taxable, and it's taxed at that same 21%, so that gives me $2,100 in taxes that I have to subtract from that to get net cash flow after taxes. And that's the end of this particular problem. And I have written out here the explanation of what I just went through, just in case you miss something, it's all written out in detail right here. And finally, I want to just finish off this section and discuss two more equations. Equation 13.8 is used to estimate the rate of return after taxes if you know the rate of return before taxes and the effective tax rate, T sub E. The after-tax rate of return is equal to the before-tax rate of return times 1 minus T sub E. That's a pretty easy equation. And then the same thing is true if you're using MAR. The after-tax minimum attractive rate of return is equal to the before-tax minimum attractive rate of return times 1 minus T sub E. And that's equation 13.9. And that concludes today's lesson, and I will do another lesson on chapter 13, taxes, soon. Thank you.